Ever wondered how the accounting cycle works? It's an essential process that helps businesses keep their finances in check. And today, we're going to take a closer look at it. The accounting cycle is a systematic process that involves 8 key steps: identifying and recording transactions, preparing journal entries, posting to the general ledger, generating an unadjusted trial balance report, preparing worksheets, making adjusting entries, generating financial statements, and finally, closing the books. Let's start with the first step: identifying and recording transactions. Every time a financial activity or business event happens, it needs to be recorded in the books. This could be everything from issuing customer invoices to writing checks. These transactions are then recorded in the company's accounting system using a method called double entry bookkeeping, which involves balancing debits and credits. Next up is preparing journal entries. These are used to record non-routine transactions that aren't recorded through a subsidiary ledger, such as accounts receivable. Journal entries can also be used to correct errors and record accruals. And in some cases, businesses can set up automatic recurring transactions for things like subscription billing or prepaid insurance expense. The third step in the accounting cycle is posting to the general ledger. This is where all the company's financial transactions are recorded and categorized. Each transaction is posted to 2 or more ledger accounts, and the total of all accounts is always equal to 0. Next, an unadjusted trial balance report is generated. This provides a snapshot of the company's financial position before any adjustments are made. It's a way to check for errors and ensure that all debits and credits are balanced. The fifth step is to prepare worksheets. These are used to summarize the general ledger data and help in the preparation of adjusting entries and financial statements. They provide a clear and organized overview of the company's financial activities. Then come the adjusting entries. These are made at the end of an accounting period to record all revenues and expenses that have not been recorded but belong to the current period. These entries ensure that the company's financial statements comply with the accrual principle of accounting. The penultimate step is the generation of financial statements. These documents provide an overview of a company's financial performance and position. They include the income statement, balance sheet, and cash flow statement. Finally, the books are closed. This involves zeroing out all temporary accounts, revenues, expenses, and dividends to begin the new accounting period. Permanent accounts like assets, liabilities, and equity are not closed. And there you have it, the accounting cycle in all its glory. From identifying transactions to closing the books, each step plays a crucial role in ensuring a company's financial health. It's a meticulous process, but it's vital for maintaining accurate and up-to-date financial records. So the next time you're looking at a company's financial statements, remember the accounting cycle that made it all possible.